The Fed is telling us that they will keep hiking rates even in the face of weakness. Do you believe them?
To some degree. I think what they've done is shift really the scale. So if we got bad economic news, say on a scale of 7, the Fed might respond in terms of an 8 or a 9. Now they might respond in terms of a 4 or 5. So they will continue to hike with some bad economic news, but they will not be over the top, right? If we really get weakness, if we get jobs going down, they will have to backtrack. This was really about resetting expectations. They had a perfect opportunity. They did that. They'll continue to do that this week. But the reality is they are going to be data dependent.
Well, they're going to be data dependent, Peter, but which data? I'm confused now because I've got equities moving, bonds moving, currencies, dollar out to record dollar strength, and even commodities giving me some movement as well. Which data dependency matters to the Fed?
I think jobs are going to be important. I think, to me, they're going to start watching this inventory build and whether that translates into lower economic output. And then finally, we do have 2 threads, and I think you did a great job mentioning this earlier. QT is starting to ramp up, and I think QT behaves very, very differently than rate hikes. I think QE really helped inflate all asset prices. I've always talked about this as being like a Newton's cradle, where you drop the ball at one end and it knocks all these things and the ball at the other end moves. So if that's what QE did and really pushed out asset prices, especially on the most risky assets, I think you're going to see the reverse of that. And that's one reason the long end of Treasury yields are behaving poorly this morning is people are starting to realize QT is coming, this balance sheet reduction is here, and that behaves differently than rate hikes and goes directly to asset prices.
Peter, can we talk a little bit more about that, particularly with respect to the paper that was presented over at Jackson Hole, talking about how this directly feeds to the leverage given to a lot of hedge funds, a lot of traders, and how that taken out of the market leads to a lot more volatility and a lot more sudden potholes in price valuations. What could we be set up for if it is as follows, if it is as fears in terms of the withdrawal of liquidity?
So I think it's going to do 2 things. One is it's going to allow everyone to move slightly down the risk curve, right? So if you wanted to buy dividend stocks, now maybe you can buy high yield bonds. If you're buying high yield bonds, you can buy IG bonds. If you're buying long duration bonds, you can buy 5-year treasuries. So I think you're going to see everyone move down the risk curve. So I think that is going to be tough for stocks to overcome. I think it's going to be very difficult for high yield and leveraged loans. I think we're going to be okay at the front end of the curve. So that to me is the main thing this is going to do, is allow everyone to shift down risk, and that's problematic. And then the other thing we're all going to be questioning is how liquid are these markets, right? Friday was ugly, but Friday was in a very thin market. And what I find most difficult to talk about is if you go back to last summer when the Fed insisted on doing QE, they kept talking about market liquidity as the reason to do QE. I can guarantee you that market liquidity, especially in treasuries, is way worse now than it was last summer.
Pete, I get very uncomfortable with a very comfortable consensus. 12 months ago, it was transitory, and now it's short and shallow. And this recession idea is something apparently for next year, for 2023. We got a real sense of that in Jackson Hole, that everyone was lined up to say almost the same thing, Pete. What do you make of that?
I'm actually much more bearish than that, and I'm not bearish because of how I think the Fed policy is going to be. I think we've already turned the corner on the economy in a negative way. We're seeing things roll over, and I'm willing to bet that by December, we're complaining about deflation and real problems in the economy rather than inflation. I think we've gone too far too quickly. Things are turning, things are rolling over. I don't like what's going on in crypto and disruptive stocks. I don't like what I'm seeing in housing. So I think people are being far too complacent.